You see it on TV all the time. Know your credit history before you apply for a mortgage. But just how important is your credit score to a lender? And could other factors come into play? Did you know that just one error in your credit history could mean losing your dream home? Anna DeSimone, CEO of Bankers Advisory, tells us just what lenders are looking for when it comes to your credit history. Anna, we want to talk about credit, and especially when it comes to qualified mortgages. Credit, obviously, very important.
Yeah. Well, with a qualified mortgage, because there were so many specific standards that the government came up with, I think the consumers as well as the mortgage lenders of America were thinking, well, there's probably going to be a standard for a credit score. And that was a very, very widely discussed and argued topic for the past year or so. Credit is a very, very important part, and it has to be reviewed for the qualified mortgage. It's one of the steps. But there is not a specific credit score that's going to be applied to the new rule.
There's not. So there's not a minimum that you have to have.
No. There's no credit score minimum, but of course there has to be, a good credit history in the repayment of someone's bills.
It seems to me in the long run, though, having a minimum credit score would be a good thing, right?
Well, a good thing for the risk-based pricing, and one of the things in mortgage lending that's very important is that on the disclosure level is the risk-based price notice disclosure. And so if a decision is made on a mortgage based on a person's credit score, under the federal regulations, there is a requirement that the consumer be given an explanation about why they were offered a specific program based on their credit score. And that form is called the risk-based price disclosure.
So, Anna, it seems to me that having the credit score would ultimately be easier for the lender. Is that true?
It would in some cases. For instance, if you're getting a personal loan, a small loan, a car loan, a credit score is easier, and it is used as a criteria in many mortgage lenders. The unfortunate thing about the credit score is it actually puts the borrower in a specific range. And they could fall out of a qualifying range because of the credit score, and there are many, many times there are errors or discrepant data on a borrower's credit history that comes out on their report, and that's going to leave them out of getting the qualified mortgage.
And as a consumer, what can you do about that error?
Well, errors can be investigated, and under a recent law that was issued a couple of years ago by the federal government, every consumer in America has a right to get a free copy of their credit report once a year. And so what the consumer does is they look at their credit report and they say, well, I don't have this car loan.
Right.
And what the credit report tells you is if you see anything wrong on your credit report, you can write to one of the 3 bureaus, and we will investigate and look into the matter and help correct these errors.
Sure. Now, how long and how far back is a lender going to look into someone's credit score? I mean, how far back would it be?
Well, a lender is always looking at all of the information on a credit score. I mean, you could have a car loan for the past 2 years and made 1 or 2 late. So you could have had a mortgage for the past 15 years and made 4 or 5 late. I mean, it's just a question of how long did you have this debt and how many errors there were. But getting back to the errors, it's a 6-month process sometimes, or 3 to 6 month process, just to investigate and get these errors fixed. And as you can appreciate, when people are looking to buy a house or refinance and take advantage of lower rates, they want to get these errors fixed pretty quickly.
Absolutely. So I guess that's a reason to stay on top of your credit score if you see purchasing something in the future.
Well, the way the credit score was derived is that there are 3 national repositories. They're called bureaus. And there's TransUnion, Equifax, and Experian. And what a repository does, I mean, the name almost gives it away. It collects information from the merchants. So all the Visa cards and the MasterCards and, Macy's department store and the car loan, GMAC car loan, they're all sending the payment history information to those repositories, and then the repositories sell and distribute the information to credit agencies.
Now, you've mentioned both credit bureau and a credit agency. What's the difference between the two?
Well, the repository is also a bureau, and there are only 3 bureaus in the United States. There are many credit agencies, and some of them are local and work maybe on a state or regional level, and then there are some that are very, very large and work on a national level. So the credit agency gets the repayment history and public record data from the repository, but the local credit agency does something more. They do investigations. In other words, they go and validate certain things. Because in addition to how long someone has had a loan or how many times they were late and what their payment history is, a credit report contains a lot of other information. It has factual information about the borrower. It has their social security number. It has where they've been living the past number of years, and it has factual information about them, which the lender has to validate.
Well, if you're a borrower who has paid all of your debt on time and your credit report seems to be pretty clean, why is there all this investigation that goes on?
Well, Kim, I hate to say it, but in the United States we've had a problem with identity theft. And in recent years, there was a $30 billion identity theft problem in America, and thanks to the work of the Federal Trade Commission and a lot of information and resources and tools that are available to consumers to stop identity theft, that number has pretty much dropped to 20 billion. So when a borrower is getting a mortgage, the lender needs to know that that is the person they say they are, because it could be a perpetrator who stole someone else's address, information, or social security, and then they're posing as someone else and trying to get a loan.
And what happens if they find out identity theft has actually taken place?
Well, the lender has an obligation to report it to the authorities immediately, and there's a process. They fill out a suspicious activity report. And there's some very, very strict laws about that, and the lenders are following it, and they've been very, very cooperative. I think the way that we've been policing the whole identity theft problem in America has been fantastic, but consumers need to understand that there is a bona fide reason why the lender is asking for a lot of information, and they're asking for explanations to clean up any discrepancies which may appear on a credit report.
Ultimately, could it protect both borrower and lender?
Yeah, absolutely.
So Anna, you've talked about discrepancies on a credit report, but give me some examples of what those might be.
Well, a most common discrepancy might take place when someone is named after their father or grandfather. So you have John Smith Sr., John Smith Sr., John Smith III. Well, John Smith III is going out and buying a house, right? But John Smith Sr. may have had a car loan, and accidentally, through no fault of anyone, that car loan is showing up on John Jr.'s credit report.
Right.
Okay. Now, maybe the car loan's being paid on time. But what is the lender going to think? Oh, I see a $295 payment here. You don't qualify under the 43% QM rule for this loan.
Right. Okay, so if that kind of discrepancy actually occurs, what does the consumer do? What does John Smith III do about that?
Well, there's a couple of things a consumer can do. First of all, they can understand that the more paperwork the lender comes up with, the easier it's going to be to document the discrepancy. So he's going to go to the relative, if he has one. And if he knows who this relative is, he's going to ask for the copy of the bill for the car loan. He's probably going to ask for copies that that person was making those payments on time. He's going to bring that paperwork for the lender, but the lender needs to contact the credit agency. The consumer contacts the credit repository. So there's a lot of steps that have to take place here. But over a period of maybe 30 days, you really should be able to get that information off the person's credit report immediately, but the bills from the relative to prove that they're making that car payment on time are really going to help.
It just seems like the safest thing to do is always stay on top of your credit report so you know if those kinds of things, those kinds of discrepancies are popping up.
Yeah, I like that idea, and I think that's good advice. I mean, I think if someone is going to be buying a house, they're out shopping, they're out looking at properties. And they should take advantage of the fact that they can get a free copy of their credit report once a year. And even if it wasn't free, they might be able to get a copy for maybe $10 or $15. And I know that TransUnion, Experian, and Equifax all offer a credit monitoring program. They offer a program where a borrower can see if new credit or something comes up in their credit report, if anyone's pulling an inquiry on them. And so a consumer who owns a mortgage, who owns a house, and has a mortgage on that house, has to take that debt very, very seriously. They can't just assume that everything else is always going to be correct all the time.
Right. Now, when we talked about identity theft, we talked about the idea of someone trying to get a mortgage and not representing themselves as the individual they really are. So I hear about mortgage fraud. Would that be an example of mortgage fraud?
Yeah, in a way, it's kind of an example of mortgage fraud, but the mortgage fraud that we read about in the papers is a little bit more widespread. Mortgage fraud is when a perpetrator, a criminal, buys a house, they get a mortgage on it, and then within 24 hours or 36 hours, they will quickly go out and get another mortgage on the same house. So then you end up with two mortgages on that same property. That's just one example of fraud. And to protect that from happening, because of that type of history that's been happening in the United States, there's a program called MERS. It's the Mortgage Electronic Registration System. So now at every mortgage closing, there's a very, very long number that is filed publicly. And that means that if there's going to be another mortgage closing, even if it's 12 hours later or 24 hours later, the next lender is going to pick up on that MERS registration number and other identifying criteria about this mortgage, and they're going to stop that fraud in its tracks.
They're going to know that there's already a mortgage on that home.
They are. It's the lien, and this can happen with a second mortgage or first mortgage. It can happen with home equity lines.
I am amazed that someone can get two mortgages on a home within 12 hours. And you said that's not the only example of fraud.
There's all different kinds of examples of fraud, and perpetrators work in groups. They work in teams. So what they'll do is they'll take one person to get a mortgage on a property while it's in the purchase and sales transaction stage. And they're applying to, county savings bank.
Right.
Simultaneously, they'll get another person to apply for a loan on that same purchase and sales agreement, only with their name on it. We call these straw buyers. And straw buyers are just fake people. And sometimes they're using false identity, and sometimes they're using their real credit report and their real Social Security number. But like I said, it's the tracking system, our closing system in America, and all of the rules that lenders have to go through. By the time the person gets their mortgage approved, there's a lot of work that's being done behind the scenes by the settlement agents, the title companies, and tracking any other activity that would have been on that property right up until the day of closing, and that's how we catch these bad guys.
All right, so as we move forward now, right up into the closing, all of this investigation and all of these checks are going on.
That's right, because the borrower is doing everything they can to get their loan approved. They're bringing in their pay stubs, they're bringing in their income statements, they're bringing in their bank statements to show they have the funds to close. They're explaining anything that might be out of step with their credit report. The lender may have asked them to pay off a bill in order to approve and be qualified for the mortgage, and they went and they paid off a bill, and they brought proof to the lender that that bill was paid prior to the closing. Then they get to the closing, and the lender is going to find out that this borrower went out and borrowed more money just before the closing.
It's a process that just keeps going on until you've signed on the dotted line, isn't it?
Yeah, well, what happens is, lenders need to make sure that what the borrower is saying on the application stays true and consistent right up until the day of closing. And so typically we're looking at maybe a 45-day time frame. And so let's just say the borrower went out and borrowed $5,000 to pay off that Visa card, right, because it was listed as a condition on their approval. Well, all of a sudden, they just took the same debt and repeated it. So what lenders now do is they'll do a credit check to see if there was any new debt taken just before the closing. Usually 2 or 3 days before the closing, they'll pull another credit check. And this isn't done for every mortgage in America, but it's done for the government-insured programs.
Okay, so Anna, let's run through the checks and balances that the lender has to do before closing day and the borrower has to do before closing day.
Everybody's doing homework. Okay?
Right.
Everyone's doing their homework. The best thing for the borrower to do is to make sure they have all that paperwork in order. They have to go back, get their pay stubs for the past 2 or 3 months. If they've been earning overtime, they need to prove that they've been earning overtime over the period of the past year or year and a half. If they've changed jobs, they have to have the W-2 from the previous jobs. They have to have all of their bank statements, their earnest money deposit. They should really have copies of their credit card payments. And if they're not filing them anywhere, it doesn't really matter if you put your bills in a shoebox and you keep it on top of your refrigerator. Because in today's day and age, almost every bank, every credit card company has everything available electronically. So the borrower needs to take a record of all the bills they've been paying. And a lot of borrowers were told by their parents or their grandparents, you don't need a credit card, don't borrow money, pay cash for everything, my son, my daughter. Well, you know what these people need to do? They need to bring copies of their utility bills, their electric bills, their gas bills. If they bought furniture on a time payment, a lender will accept what they call non-traditional sources of credit. So people that haven't established credit yet or don't have a Visa or MasterCard, that's okay. They can bring in copies of a landlord's bills, anything that can prove that they have established a history of paying a bill on time. I think what the most important thing that the lender wants to look for, which is really hard to do from a credit report, and that is to find out if there's a long history here of financial management.
Well, Anna, this has been great advice for consumers for sure, and obviously it's important that you keep records, you be prepared when you go to get that loan and come with all of that information at hand, because that lender needs to make sure that you can pay that bill.
That's right. You said it.